Hi guys, it's Chrissy and
Jake.
And we are here to talk on Mortgage Monday. So
Good morning.
We were actually just chatting this morning. I actually woke up and thought, well, Jake, you've been in the business for a long time. How long has it been?
18 good long years.
18 years. So Jake's actually, you were around for the last recession.
I was.
Yes. So we've heard a lot in the news about recession this, recession that. Oh my gosh, let's panic about this, let's panic about that. Love to hear your take on it.
Thanks.
So.
Well, I hope I have some. Well, I definitely have a lot of opinions.
Okay.
But that's sort of, it's a broad topic, but I think there's 3 or 4 things that are the most important things to look at.
So there's 3 or 4 most important. What would you say? I'll just let you go. What do you think?
Well, I would say this. The last recession started in 2006.
Okay.
Towards the end of 2006, and by 2008, the financial world was in shambles. We were kind of sort of nearing the bottom of the recession. What brought that on? Have you ever seen the movie The Big Short?
I have not seen that movie.
Okay, so
I have to watch it.
Yeah, so if you guys are really interested in knowing more about this topic, add The Big Short to your watch list on on Netflix or Amazon or wherever you guys rent movies. But that will do a much better job explaining this to you than me.
Okay.
So, what happened was, leading up to 2006, in the mortgage market, there was a massive deregulation of the mortgage business, and the mortgage, and what the banks required lenders to look for before issuing a loan.
Okay.
Does that make sense?
So there were rules, they just took away those rules.
The rules were in place.
Okay.
And then they were slowly taken away. And if you rewind back to September 11th, 2001,
okay,
when the whole, that started a major global financial problem for everybody.
Okay.
And I won't get into all the details, but what happened between 2001 and 2008 was a slow deregulation of all the mortgage-backed securities to kind of help stave off the financial problems that were caused by 9/11.
Okay.
Does that make sense?
It does make sense. So they're trying to push people to buy by decreasing regulations.
Trying to create business, trying to create economy by taking away restrictions so people could buy homes and build, and kind of that money went back into the economy. And so 2001 to 2006, we had all these different types of loan products that had never before been introduced, such as, you've heard of a stated income, stated asset loan. Okay.
Well, for those that don't know, what is that?
So stated income, stated asset is if you've recently applied for a loan in the last few years, you've been required to provide your tax returns, W-2s, bank statements, and the lender would meticulously review all of these documents. And if there was a $1,000 deposit put in that bank statement, that wasn't.
Lenders ask where it came from.
Lenders ask, okay, where'd you get that $1,000 from?
Okay.
Before, a stated income and stated asset loan allowed you to get a loan by just merely selecting how much money you had in your checking account and writing the amount of money that you made on a monthly or annual basis on the loan application. Stated income, stated asset.
No bank statements.
No bank statements.
No proof.
No proof. Just take your word for it, and we'll give you a loan based on that.
Okay.
So there was the stated income, stated asset loan, the stated income verified asset loan, and in fact there was no income, no asset loans, and we called these loans the Nina, the Siva, and the Sisa.
Oh my gosh.
Better known as the Russian sisters.
Okay.
That's kind of the term we use in the business, is like the Russian sisters. Those are the loans that brought down the house, right?
Okay.
Because what happened when we made these loans, and there were a few mortgage brokers and a few loan officers that were bad players that really did a bad job and brought a bad reputation to the business by doing things that were illegal.
Yeah.
But those products existed in the marketplace because the big banks, the Bear Stearns, the Wells Fargos of the world, they put those products in the market Because of the deregulation, again, going back to 2001, what was needed to stimulate the economy.
Okay.
So in 2006, what happened basically was from one day, without going into all the details, from one day to the next, all those products were no longer sellable in the secondary market, meaning people weren't, the big investors weren't buying those loan programs as they were before. And so because there was not these loan programs went away for people who really didn't make that kind of money, who really didn't have that kind of assets, the whole business of that sort of business just stopped from one day to the next.
Okay.
So you have all these, what do you think would have happened when all these loan programs were made available? What would happen to home prices in those?
Go up. There would be a lot more demand
because
people can buy. People are given this power to buy, so they can drive these prices up. So we were seeing kind of an artificial inflation of these prices. Is what was going on, and then we had people. From what I'm getting, we're seeing these people that are saying, "I have all this money to pay back this loan." They get the loan, they can't pay it back. Okay.
Exactly. And so when all these people who had these loans were on 2, 3, or 4 year adjustable rate mortgages, that their interest rate went from 7% to 12% from one day to the next, 3 years after they bought the house, and they turned around to try to get financing. You say, "Hey, I want to get financing." What happened?
We can't.
There's no financing because those programs went away.
Yeah.
Because what was happening with those loans, let's say there was somebody who really did document their income and assets the standard way through tax returns and pay statements and all the normal documentation, normal based on today's standards. And then there was a loan right next to that with somebody who had just stated their income, stated their assets. And so lenders don't just buy 1 or 2 loans at a time, they buy tranches of loans and tens of millions or $100 millions of dollars, and lenders take these big tranches of loans. So I'm Wells Fargo and I have this tranche of loans here in your Bank of America, and you say, "I want to buy that $100 million tranche of loans." And I say, "Okay, give me $105 million for it." You say, "Okay, here's $100 million and $5, right?" But what was happening is the people who packaged these loans and created these big tranches of loans, they would put a stated income loan right next to a regular full documentation loan, and they say, "Yeah, this is a good loan. We've statistically analyzed the algorithms behind this, and we're sure that this is a safe loan." So what you would do as Bank of America, you take the $100 million and you turn around to your securities division, and some guy from your securities division would talk to the financial planner who managed the Oklahoma State Retirement Pension Fund for a bunch of sweet old gentlemen and ladies who worked as teachers for Oklahoma for 50 years, and they're retired, right? So those folks would end up buying this tranche of loans, and they were hoping to receive what? Income. Income. Yeah, because people were supposed to pay the loans. They'd pay Wells Fargo. Wells Fargo would pay the financial planning company. The financial planning company would replenish their account with interest over time. So what happened was all of these tranches of loans just went bad. And
they couldn't pay them back.
They couldn't pay them back. And so that was like the whole effect of, Main Street all the way down to Wall Street, sort of this vicious cycle of deregulated lending products that sort of caused the financial crisis of 2008.
So fast forward to now.
Fast forward to now.
You're saying now we have regulations in place.
Really tight regulations.
So if anyone's applied for a loan, I know this from my clients, anyone that's applied for a loan lately, you have to submit basically your whole life on paper. Like, here's all my paperwork, here's where that money came from, here's all of that. So the differences between the two, like seeing back when you went through that and now seeing what's going on right now, do you see any similarities?
I think there are some similarities, but I also think that there's a lot of differences because, well, for example, those highly deregulated loan products are no longer in the market.
They're gone.
There are some sort of loans. They're called non-QM loans now. Now it's against the law to put a stated income loan together with a fully documented loan and sell those and securitize those loans in the overall economy, right? But there are lenders that offer what they're called non-QM loans, where they do allow stated income loans, but they require 10%, 20% down, and they keep those loans away from
stated income loan, not stated, from loan documentation.
Qualified mortgages through,
it
it's through full documentation loans through Fannie Mae and Freddie Mac. They're called qualified mortgages. So there's a qualified mortgage pool that still works the same way as it used to with the pension fund and so on and so forth. And then there's these non-QM lenders, and they're standalone entities that they believe that they've assessed the risk efficiently enough to allow those type of products. But they service the loans, they never sell the loans. If you get a loan from a non-QM lender, your loan's going to stay with them until you refinance or to pay it off. They're not allowed by law to put them in to these other big $100 million tranches with Wells Fargo and Bank of America. So I don't think there's like an impending financial crisis that's going to be brought on by the mortgage industry, right? But if you look at the stock market, do you follow the Dow Jones at all?
A little bit. Not a whole lot. I know there's people out there that do.
Yeah. So if you look at where the Dow Jones was in 2009, it dropped below 7,000, right? Fast forward to 2019, we're seeing that double peak today at like 27,000. So
the market's good.
The market's good, but it's showing signs of weakness, right? And then also over the weekend there was a major incident between, somebody dropped a drone attack on Saudi Arabia, right? And so there's 50% of Saudi Arabia's oil production is put on hold. Some people say for a couple days, some people for a couple weeks. But what that means, that's like the global problem coming about that possibly could cause the macro economy to suffer. And then there's the Chinese, the trade war with the Chinese, that people call it Trump's trade war with the Chinese. Well, whoever's trade war it is, there's a trade war happening with China right now that's causing a rift in folks' employment, right? But if you look on the flip side, average credit scores nationally are over 700. Most people have a lot of equity in their homes. So because people have high credit scores and a lot of equity, that means they've got a buffer against impending job slowdown, right? So is there something on the far horizon, possibly on the near horizon, if there's a big global cataclysmic event that would cause the economy to shut down, like 911, for example, like what happened last time? Then I'd be worried. But for now, we also live in this micro economy of Maricopa County, which is.
I'm gonna hold it up. It just fell. Okay.
Chrissy's phone decided
went down.
It was.
Yeah, we're good.
Artificial intelligence.
Yes. Oh wait, it's back up.
Good.
Okay, we're good.
Okay.
We're back. Okay.
So if you look at the microeconomy that we have here in Maricopa County, Maricopa County's been the fastest growing county in the country for year after year.
We did it again.
I'm just gonna hold it up.
Okay, I'll wrap it up real quick. So lots of industries moving to Phoenix, the Phoenix areas. Lots of stable jobs are being opened. Intel hired, is hiring on a hiring.
Yeah, I keep hearing people coming for Intel, so they're hiring.
So because, generally speaking, Maricopa County's real estate market is extremely healthy right now, and barring some sort of major cataclysmic event, I don't see house values dropping anytime soon.
Okay. That's the same that I've been reading too with. So it's great to hear it from someone who has gone through this and sees what the difference is. So very great information. Thank you so much, Jake.
With a grain of salt.
Yeah.
That's my opinion.
So you can find me on this channel. You can find Jake at
JakeTaylor.com.
And if you guys want to talk recession, you guys want to talk loans, talk about interest rates, whatever we need to do with this market, give us a call.
Feds are meeting at 2 p.m. today, Eastern Time, and we do expect to see rates drop again.
Awesome.
Today.
So get in touch with us. We'll talk to you guys soon.
Thanks a lot.
Thanks for watching.